Welcome back to CEO Money. I'm Michael Youre, your host, in studio with Ed Baxter and George Seay of Annandale Capital. All right, George, welcome to the show.
Thanks. Great to be back.
All right, I'm glad you're here. All right, Ed and I have got all kinds of questions for you. The world, according to George, I want to put that out there as a funny one, but you're responsible for a lot of money, and you're responsible for being right. You can't really afford to be wrong. So in your day-to-day business, where are you seeing new trends? How do you see the economy unfolding? Where are we? And I'm going to back up a little bit because that's a lot of latitude. You can go anywhere with this.
I think that the whole have to be right quote, which is true, I think a lot of people take that and they freeze up because it's too much pressure and you take on too much responsibility and it gets very personal and you get upset easily and you make bad decisions. It's like Warren Buffett said the other day, when you're under duress, you just don't make good decisions. So I think in this business, you have to take what you do very seriously, but take yourself not seriously at all and relax, make the best decisions you can, and then you just live with them. You have to do that. Now, that's a good policy for investors too, is not to press, not to get too upset, be unemotional, be cool, calm, and collected, make the best decisions you can. And if you miss some, and in investing you always miss some, just dust yourself off, get back up, and try again.
Yeah, so, well, you're cool under fire, and that's the point. But talk to me about how you see the world unfolding. Where are we, and where do you see pockets of opportunity that you're positioning yourself and your clients for?
The level of complacency out there right now, especially among the big banks in Wall Street, I'm not going to name any particular banks, but I heard a presentation about a month ago where it was always sunny, it was never going to rain, it was 70 degrees perpetually, no wind. We're in a boat. It's on a stream with no rapids. I mean, it was just this idyllic picture being painted of the markets. And they do have a lot of good points. You know, the valuations after tax reform aren't just terrible. They're high, but they're not just terrible. The economy's growing great. Tax reform is going to really help. There's a lot of things to be really excited about, but it's always the things you're not expecting and not looking for. And I had a opportunity to visit with Paul Singer, the really well-known hedge fund manager out of New York who runs Elliott Management. They run $40 billion. It's an activist fund. And he brought up what I thought was an excellent point, is that you really don't have competition for stocks currently, but if we get interest rates going up another 100 basis points or so, you do. And that's what the Fed is primed to do over the next year and a half, is raise at least 4 times. And then he also brought up the balance sheets of central banks around the world and how escalated they are, and then the sovereign debt situation, which everybody was really hot and bothered about 6 years ago, and then it just poof disappeared and nobody talked about it anymore.
Right.
But that's still a real issue, is the amount of leverage out there and how that could all of a sudden pop up and scare people to death. So I don't think it's a matter of if when we have a significant correction, and 1 month ago was not a significant correction. It's not if, it's just when. And it doesn't look imminent to me, but it probably in the next 2 to 3 years, I'd bet a lot of money we get a significant correction.
I know a guy that's going to be a journalist with us, and he's been around the investment world about as long as both of us have. And his concern is that people are not going into short-term debt as fast as they should relative to what's happening with the market. And he's got a whole formula for why he thinks the market is going to pull back now. But I wanted to understand where you think the pockets of opportunity are, and also give me your idea, because we both are on the same thing. We're both looking at the bond market breaking lows and lows and lows and lows. We know what that means. So banks could do better because of the spread, but you've got to. It's one thing for me to say it. It's a whole other thing for you to put large money on it and bank on your new trend being right.
Well, you just sized up the bond market well. If you're a borrower, you want to just be as long as possible the last couple of years because your rates were just historically low, what you're going to get. If you're an investor, you want to be as short as possible right now so you're not exposed to some huge loss in your bond portfolio because you've overextended. That's what we've been doing for the last 3 or 4 years, where we basically had a very, very short duration on our bond portfolio. And we're really excited all the rates are going up because it just means we're actually going to make a decent return on our bond portfolio once these increases get through the system and you stop trading water in the meantime. We don't see a whole lot of things to be excited about right now. We have maintained or increased slightly our exposure to international stocks.
Mm-hmm. Why?
Well, because reversion to the mean is one of the few things in the investing world that works, and international stocks, except for last year, have underperformed domestic stocks for a decade. And it's just time for that to reverse. The only problem with that trade is that everybody likes it. And when everybody likes it, I get suspicious. The only other thing we like immensely, and we continue to like immensely, is oil and gas minerals.
Yeah, you were saying it last time. Why?
They just work so well. I'll give you an example. So we bought some minerals in, of all places, Colorado and Nebraska about 6 years ago in the DJ Wattenberg Basin up there. We paid about $1,500 an acre, something like that. And we just got a lease bonus from somebody who leased some of our property for $4,100 an acre. So we sold the right to drill wells on our property for 2.5 times what we paid for the right itself. So there's just so many ways you can win in oil and gas minerals. You get lease bonuses, you get royalty payments, and once your land starts getting drilled on, the price you paid for the real estate or the real property right is going to be higher than what you paid for it. So there's 3 ways to win. And you're not using any leverage, unlike real estate, unlike private equity and some other areas, which it increases your risk. Mm-hmm. And it's an asset that you can hold on to forever if you want to. So we still like that, and prices are not out of control in that area, except for a few areas like the Delaware Basin in West Texas.
All right, and the political landscape is tending that way anyway. Was that your foresight, or you just know that business and that's where you were going to move based on other criteria?
I had no idea where the political aspects was going to go. Sometimes you just get lucky.
Yeah.
But it's funny because it looked a little gloomy in Colorado politically for shale drilling about 2 or 3 years ago. And the Democratic governor up there, who normally would be against shale drilling, took a look at the economic impact, and it had already created 30,000 to 40,000 jobs in Colorado, was generating billions of dollars of economic activity per year. And he went, I'm not crossing this. This is too important for the state at this point. So got too entrenched. And the same in Pennsylvania. It just has so many jobs at risk in Pennsylvania to shut it down. So unlike New York, unlike the Northeast, some other areas that are still in that Marcellus Utica area, Pennsylvania's too pregnant, so to speak, to terminate their drilling up there. It's too important to the state.
We got time for one more pearl of wisdom from you. Any other? Because we got oil, we got short-term rates.
The whole thing of this is a silly football analogy. They say if you get in a football stance, don't be leaning too far forward, don't be leaning too far back. So I think it's a really good time for investors to not get out of the market, because you can never time the market right, or if you do time it, you've just gotten lucky once. But don't get too aggressive right now. You just stay really well balanced in terms of how much you have in stocks, how much you have in bonds, how much dry powder you have to take advantage of opportunities. It's a great time to be balanced.
Good. All right. Anything coming up for you when it comes to events, newsletters, anything like that before we close?
We are doing some extensive research in oil and gas minerals, so that'll be coming out before too long. So,
good. All right. Thanks for being here, George.
Thanks, Michael. Really enjoyed it.
You're welcome. George Seay, Annandale Capital. You've been listening to CEO Money with Michael Youre, Ed Baxter. We're going to head on down to the Network Club with George, and the segment brought to you by Tycon Partners. We'll be back with more great content for you tomorrow.